Most traders lose because they chase price movements like sheep following the herd. But the operators, those who consistently extract millions from the market, have mastered one critical ability: reading the composite operator's intentions through volume and price action. They see accumulation where others see chaos, distribution where others see opportunity. This single skill transforms gambling into a systematic transfer of wealth from the many to the few. Let me be perfectly clear about something that most traders never grasp. The market is not a random, chaotic entity driven by millions of independent decisions. No, the market is a carefully orchestrated campaign, manipulated and controlled by what I call the composite operator, the combined force of large interests, banking houses, and professional operators who have both the capital and the strategic acumen to move prices deliberately. Now, here's the critical insight that separates the successful speculator from the perpetual loser. The composite operator cannot hide his tracks. Every share he accumulates, every position he distributes, every manipulation he engineers leaves indelible footprints in the tape. The question is not whether these footprints exist, they always do, but whether you have developed the trained eye to detect them. Consider what happens when the composite operator decides to accumulate a large line of stock. He cannot simply march into the market and buy aggressively. Such action would immediately drive prices up against him, forcing him to pay progressively higher prices for each successive block of shares. This would be ruinously expensive and, frankly, amateur work. No, the professional operator is far more cunning. Instead, he accumulates during periods when the public is discouraged, fearful, and eager to sell. He uses every minor rally to absorb the selling that emerges. He may even engineer downward pressure through strategic short selling or negative publicity to shake out weak holders. During this accumulation phase, you will observe a peculiar phenomenon: prices make little net progress despite substantial volume. The stock churns, moves sideways, frustrates the impatient trader who craves immediate action. This is where volume spread analysis becomes your most powerful diagnostic tool. Watch the relationship between the price range of each bar and the volume that produced it. When you see narrow price spreads on high volume, the composite operator is absorbing supply, buying every share that frightened holders will sell him, but doing so without allowing price to rise and reveal his hand. When you observe wide price spreads downward on climactic volume, followed by immediate reversal, you are witnessing the final shake out, the capitulation that marks the end of his accumulation campaign. The reverse occurs during distribution. Here, the operator uses every minor decline to unload his holdings to an eager public convinced that higher prices lie ahead. You will see price advance on diminishing volume, effort without result, as the operator carefully feeds stock to the demand created by optimistic buyers. The professional trader, the one who consistently extracts profits from the market, has trained himself to recognize these patterns. He does not trade based on hope, tips, or emotional impulses. He trades based on evidence, the cold, hard facts revealed through the scientific analysis of supply and demand as demonstrated through price and volume. This is not prediction, this is detection. And detection, my friend, is infinitely more reliable than speculation based on mere opinion or wishful thinking. I want you to understand a fundamental law that governs every significant movement in the stock market, a law as immutable as the law of gravity. This is the law of cause and effect, and your mastery of this principle will determine whether you join the ranks of successful speculators or remain among the bewildered masses who continually lose money. Here is the essence: every effect must have an adequate cause. In market terms, every substantial price movement, what I call the effect, must be preceded by a period of preparation, the cause. You cannot have a significant markup in price without first having a period of accumulation. You cannot have a prolonged markdown without first having distribution. This is not theory. This is observable fact that repeats itself with remarkable consistency throughout market history. Think of it this way. If a large operator wishes to move a stock from $40 to $80, he must first accumulate a sufficient line of shares during the accumulation phase. The greater the price objective, the longer and more extensive the accumulation must be. This accumulation period creates the cause. The subsequent markup creates the effect. The size of the cause determines the extent of the effect. Now, how do we measure this cause? Through careful analysis of the trading range and the time spent in accumulation or distribution. I have developed what I call the point and figure method for this very purpose, to count the cause and project the probable effect. When you observe a stock moving sideways in a trading range, absorbing volume day after day, week after week, you are witnessing the creation of cause. The wider the trading range and the longer the time spent in this preparatory phase, the greater the potential movement that will follow. Consider the 4 distinct phases of the market cycle. First comes accumulation, the professional operator quietly gathering shares from discouraged holders, often after a prolonged decline. The public has lost interest, the news is uniformly bad, pessimism reigns. This is precisely when the smart money accumulates. Second is the markup phase. Having completed his accumulation, the operator now allows price to advance. He supports every natural reaction, uses positive developments to stimulate public interest, and gradually attracts the buying power of the public, who now see the stock advancing and wish to participate. The markup continues until his price objective, determined by the extent of his accumulation, is reached. Third comes distribution. Here, at elevated prices with optimism abundant, the operator systematically unloads his holdings to the eager public. He uses the same sideways, churning action you saw in accumulation, but now he is selling every rally rather than buying every dip. Again, time and range create cause, this time for a downward effect. Finally, the markdown phase arrives. Having distributed his shares, the operator may even accelerate the decline through short selling. Prices fall, the public holds and hopes, and eventually capitulates near the bottom, precisely where the next accumulation phase begins. The professional trader who understands this cycle possesses a roadmap. He knows where he stands in the market's rhythm. He positions himself with the operator during accumulation, rides the markup, recognizes distribution, and steps aside during markdown. This is scientific speculation, not gambling, not hope, but calculated participation based on understanding the eternal cycle of cause and effect. Now we come to one of the most revealing diagnostic tools in the entire arsenal of technical analysis, the relationship between effort and result. This principle, when properly understood and applied, gives you a window directly into the intentions of the composite operator. It tells you whether the current price movement is genuine or manufactured, whether accumulation or distribution is occurring, and most importantly, when a major reversal is imminent. Let me state this principle plainly. Effort is represented by volume, result is represented by price movement. In a healthy, trending market with genuine participation, increased effort should produce increased result. When you see heavy volume, significant effort by market participants, you should see correspondingly wide price spreads. This harmony between effort and result indicates that supply and demand are in natural balance, with one side clearly dominating. But here is where the untrained eye fails and the professional succeeds. When effort and result diverge, the market is telling you something of profound importance. This divergence reveals the hidden hand of the operator at work. Consider first the case of price advancing on diminishing volume. The public sees rising prices and assumes strength. They pile in, eager to participate in what appears to be a bullish move. But what does the professional observer see? He sees effort declining while result continues. For the moment, this is distribution masquerading as strength. The operator is using the public's enthusiasm to unload his holdings. Each rally brings forth eager buyers, and he accommodates them by selling. The diminishing volume tells us that participation is waning, that supply is overwhelming demand, and that this advance cannot be sustained. I have seen this pattern repeat itself countless times at major market tops. Prices grind higher on progressively lighter volume. The public becomes increasingly confident, and then suddenly, seemingly without warning to those who weren't watching the volume, the market collapses. But there was warning, clear as daylight to anyone who understood the relationship between effort and result. Now consider the opposite scenario. Wide price ranges downward on climactic volume. Here you have maximum effort producing maximum result in the downward direction. Every holder who can be frightened into selling has sold. Volume reaches extremes as panic grips the market. But watch what happens next, and this is critical. If prices fail to continue downward despite this enormous selling pressure, if the next session shows a narrowing of the spread or even a reversal on sustained or increased volume, you are witnessing absorption. The composite operator is stepping in, buying every share that panic-stricken holders will sell him. This selling climax, marked by the divergence of continued heavy volume but cessation of downward price progress, signals that supply has been exhausted and accumulation is beginning. The professional recognizes this pattern and positions himself accordingly, buying when the public is in full retreat. There is yet another crucial divergence, narrow spreads on heavy volume. When you see substantial volume but little price movement, churning is occurring. In a trading range after a decline, this indicates accumulation, the operator absorbing supply without allowing price to rise. In a trading range after an advance, this indicates distribution, the operator unloading holdings without allowing price to fall precipitously. The student who masters this principle of effort versus result possesses a remarkably accurate gauge of market conditions. You are no longer guessing, you are reading the evidence that the market itself provides through the mathematical certainty of supply and demand as expressed in price and volume. I must now reveal to you one of the most diabolical yet predictable tactics employed by the composite operator, a maneuver so consistently effective that it has separated countless amateur traders from their capital, while simultaneously enriching those who understand its purpose. I speak of the spring and the thrust, two deliberate false movements designed to trap the unwary and shake out the weak-handed before the real campaign begins. Let me explain the spring first, as it occurs during the accumulation phase and represents one of the final acts before markup commences. Picture this scenario: a stock has been trading sideways for weeks or months in a clear trading range. Support has been established at, let us say, $40. The public, having observed this support hold repeatedly, places their stop-loss orders just beneath it, perhaps at 39.5 or 39 3/4. They believe themselves clever, protected against further loss, but the composite operator knows exactly where these stops are clustered. He knows the psychology of the amateur trader as intimately as a poker player knows his opponent's tells. And so, with calculated precision, he engineers a penetration of this support level, a spring below the established range. Stop-loss orders are triggered. Alarmed holders, convinced that support has failed and further decline is imminent, rush to sell. The weak hands are shaken out completely. But observe what happens next, and this is the key: prices quickly reverse and move back into the trading range, often with vigor. The downward penetration was false, a trap. The operator has now accumulated additional shares at favorable prices from those foolish enough to sell at precisely the wrong moment. Within days or weeks, the markup phase begins in earnest, and those who sold in panic watch helplessly as prices advance substantially without them. I have personally witnessed this pattern hundreds of times. The spring serves as the final preparation, the last shakeout before the campaign of markup. The professional trader who recognizes this maneuver does not sell into the spring, he buys. While the amateur flees in fear, the informed speculator positions himself alongside the operator. Now consider the upthrust, which is the spring's evil twin occurring during distribution. Here, after a prolonged advance, the stock trades sideways at elevated levels. Resistance is established perhaps at $80. The public, seeing this resistance tested multiple times, believes a breakout above it signals further substantial gains. They prepare to buy on the breakout, some even placing buy, stop orders above resistance to ensure they don't miss the move. The operator, having completed his distribution and wishing to unload his final shares, engineers a false breakout, an upthrust above the trading range. The public's buy, stop orders are triggered. Enthusiastic traders pile in, convinced they are catching the beginning of the next leg higher. Headlines may proclaim, "Stock breaks out to new highs." But watch the volume and the subsequent price action. If the breakout is accompanied by climactic volume yet fails to make further progress, if prices quickly retreat back into the trading range, you have witnessed an upthrust, a trap for the bulls. The operator has successfully distributed his remaining shares to the eager crowd who bought the false breakout. Within a short time, markdown begins, and those who bought the upthrust suffer significant losses. The trader who understands these tactical maneuvers possesses an enormous advantage. He recognizes that the operator must employ these deceptions to complete his campaign. Rather than being victimized by springs and upthrusts, he uses them as high-probability entry and exit signals. This is the difference between being the hunter and being the hunted. I have saved perhaps the most important lesson for last, because all the technical knowledge in the world, all your understanding of accumulation and distribution, of effort and result, of springs and upthrusts, will avail you nothing if you cannot master yourself. The greatest battle in speculation is not against the market or the composite operator, it is against your own emotions, your own psychological weaknesses, that the market exploits with merciless efficiency. But here is the liberating truth I wish to impart. When you truly understand market structure, when you grasp that price movements are not random chaos, but engineered campaigns following predictable patterns, you acquire something far more valuable than mere technical skill. You acquire emotional immunity. You develop the psychological fortitude that separates the professional from the gambler. Let me explain how this transformation occurs. The amateur trader, ignorant of market structure, experiences the market as a terrifying roller coaster of inexplicable movements. Prices rise and he feels excitement, greed, the fear of missing out. Prices fall and he experiences panic, despair, the overwhelming urge to salvage whatever he can. He buys at tops driven by euphoria and sells at bottoms driven by fear. His emotions are puppets dancing to strings pulled by movements he cannot comprehend. But you, the student who has studied market structure, you see something entirely different. When prices are churning sideways after a decline, while the public grows increasingly discouraged and sells in disgust, you recognize accumulation. You understand that the composite operator is methodically gathering shares. This knowledge insulates you from the prevailing pessimism. While others see hopelessness, you see opportunity. You are not guessing or hoping, you are observing evidence and positioning yourself accordingly. During the markup phase, when prices are advancing and the public grows increasingly enthusiastic, you do not succumb to greed. You understand that this advance was preceded by accumulation, the cause that created this effect. You can measure approximately how far the markup should extend based on the extent of the previous accumulation. You participate in the advance, certainly, but with measured confidence rather than reckless abandon. You know this is part of the natural cycle, not some miraculous permanent ascent. Most critically, when you observe distribution, when you see prices advancing on diminishing volume, when you recognize upthrusts and selling into rallies, you do not fall victim to the prevailing optimism. The financial press may be bullish, your neighbors may be boasting of their profits, the public may be rushing in with both hands, but you remain unmoved. Your understanding of market structure tells you that the operator is distributing, that the markup phase is concluding, that markdown will inevitably follow. You exit your positions calmly, methodically, while others are still buying, and during the markdown phase, you feel no despair because you are not participating. You have already sold. You wait patiently, knowing that this decline will eventually exhaust itself in a selling climax, creating the next accumulation opportunity. This is the ultimate benefit of understanding market structure. It transforms your relationship with the market from emotional reactivity to rational observation. You are no longer buffeted by fear and greed because you comprehend the underlying machinery. You see the market not as a capricious enemy, but as a repeating cycle of logical phases. The trader who achieves this psychological mastery, grounded in structural understanding rather than mere willpower, has crossed the threshold from amateur speculation to professional operation. He trades not with his emotions but with his intellect, not on hope but on evidence, not impulsively but systematically. This mental discipline, born from genuine comprehension of how markets truly operate, is the final and most crucial skill that transforms the perpetual loser into the consistent winner. And so we arrive at the end of our discussion, but I sincerely hope it marks the beginning of your true education in the science of speculation. Let me distill what we have covered into its essence. The single skill that separates millionaire traders from everyone else is not some mystical gift or stroke of good fortune. It is the ability to read and interpret the footprints of the composite operator through disciplined observation of price and volume. Everything I have shared with you today, the detection of accumulation and distribution, the understanding of cause and effect, the analysis of effort versus result, the recognition of springs and upthrusts, and the cultivation of emotional discipline, all of these are facets of this one central skill. They are not separate techniques to be employed independently, but interconnected components of a complete methodology. The market, I assure you, will continue to present the same patterns tomorrow, next month, and next year that it has presented throughout all of recorded market history. Human nature does not change. The tactics of the composite operator do not fundamentally change. The cycles of accumulation, markup, distribution, and markdown will repeat endlessly because they are rooted in the immutable laws of supply and demand, manipulated by those with sufficient capital and knowledge to do so. What must change is you. You must commit yourself to the study of these principles not as mere theory but as observable reality. You must train your eye to see what others overlook, to interpret the evidence that the market provides daily through its price and volume action. You must develop the patience to wait for proper conditions rather than forcing trades based on impatience or emotional impulse. I will not mislead you with promises of easy riches or quick success. The path to consistent profitability in speculation is paved with study, observation, discipline, and inevitably some painful lessons. But I can promise you this: if you approach the market as a professional, armed with understanding rather than hope, guided by evidence rather than emotion, and positioned with the composite operator rather than against him, you will have transformed speculation from a gamble into a calculated business enterprise. The choice before you is clear. You can continue to trade as the public trades, buying on enthusiasm, selling in panic, forever contributing to the wealth transfer from the many to the few. Or you can dedicate yourself to learning the craft of scientific speculation, joining the ranks of those who consistently extract profits because they understand the game being played. The market will test you. It will tempt you with apparent opportunities that are traps. It will frighten you when you should be boldest. It will seduce you when you should be most cautious. But if you have truly mastered the skill of reading the composite operator's intentions through price and volume analysis, if you have internalized these principles until they become second nature, you will navigate these tests successfully. Remember, the tape tells all. The evidence is there for those with eyes trained to see it. Your success or failure will not be determined by market conditions, economic news, or chance. It will be determined solely by whether you have developed the skill to read what the market is actually doing rather than what you hope or fear it might do. Now, go forth and study. Observe the market with fresh eyes. Apply these principles systematically. And most importantly, never stop learning, because in speculation, the moment you believe you have nothing left to learn is the moment you begin your decline into the ranks of the consistently unsuccessful.